Working capital policy. Working capital is one of the most important decisions taken by the top management within business organizations. Why working capital is so important? Because it helps business run, it helps business operate, it helps business work. Consider the example of blood. Like the main organs of the human body are, hands, legs, eyes, nose, uh, tongue, brain, etc. But if there is no blood within the human body, all these organs are of no use. So just like what the blood provides to the human body, it helps the human organs work. Similarly, working capital helps businesses work, helps businesses operate. So let's start by defining the working capital. First of all, the basic concepts. Remember, working capital or gross working capital refers to the current assets, means those assets which a firm expects to convert into cash within a year. For example, cash, inventory, accounts receivable. There are also other types of current assets, but these three, the cash, inventory, and accounts receivable, are the most common. We usually refer current assets as the working capital or gross working capital. And all of you must be familiar with the current assets. There are two types of assets on a firm's balance sheet. The one are current assets and the other are the fixed assets. Current assets are those assets which can be converted into cash within a year. Within a year means short time period. We can also say that current assets are those assets which give benefit to the business organization within short term. Current assets are also called liquid assets because it provides liquidity to the business organization, to the firm. Now, what do we mean by liquidity? Liquidity is the ease of converting an asset into cash without loss of time and money. If we can convert an asset into cash with ease, means easily, we easily convert an asset into cash without losing time or without losing money, without incurring any extra cost. So we say that this asset is a liquid asset and this asset has liquidity in it. All right. Now, what is net working capital? Net working capital refers to the current assets minus current liabilities. Means when we subtract current liabilities from the current assets, we call it net working capital. What are current liabilities? Similar to the current assets, those liabilities which a firm has to pay within a year. Like we just discussed the current assets, those assets which can be converted into cash within a year. Similarly, current liabilities are those liabilities which a firm has to pay within short time period, short term, or within a year. For example, accounts payable, short term bank loans, and commercial paper, etc. You are familiar with the concept of commercial paper. Commercial paper is a short-term security that is issued for short-term financing. The maturity of commercial paper starts from 3 months and it goes up to maximum 1 year. Working capital policy is the firm's policy about its working capital level and how its working capital should be financed. When we manage working capital, means the current assets, we decide the level of working capital, that how much working capital should we have, how much working capital do we need, and how much working capital should we have, how much we have, or how much further we need, etc. All this is called working capital policy. At the same time, not just deciding about the level of working capital, but also how this working capital, how these current assets should be financed, how we will finance these current assets or the working capital. It is also part of the working capital policy. Why firms accumulate working capital? In other words, what is the purpose of having working capital? Number one, the purpose of having current assets on a firm's balance sheet is to pay short-term obligations, means current liabilities or short-term liabilities. Look, the maturity of current liabilities are maximum up to 1 year. Means the nature of current liabilities is short-term. The maturity is maximum up to 1 year. So in order to pay those short-term liabilities, the liabilities having maturity of maximum 1 year should be paid back or satisfied with similar nature of assets, which are obviously the current assets. Okay, current assets are assets which can be converted into cash within a year. So those current assets are necessary to pay off the current liabilities. Number two, to fund business operations. Remember this thing that the profitable assets are the fixed assets, the land, property, building, machinery, equipment, etc. So these fixed assets are obviously the profitable ones, but to operate those profitable assets, we need current assets. Current assets are required by the business organizations to fund those business operations, like buying the raw material, then processing those raw materials to convert into finished good, and then selling those finished goods within the market to earn revenues. So obviously we need current assets to fund our business operations, to run our business, to operate our business. If a firm has enough current assets to pay its current liabilities, such firm has no liquidity problem. Obviously, we just discussed the concept of liquidity. If a firm has enough current assets on its balance sheet to pay off its current liabilities, in other words, if a firm has more current assets than the current liabilities, so we will say that such firm has no liquidity problem. How do we measure this thing, that does a firm has a liquidity problem or not? For this purpose, we use the current ratio, the most simple and the most famous ratio. Everybody knows it. Current ratio is equal to current assets divided by current liabilities. If this current ratio is greater than 1, then it means that the firm has more current assets than current liabilities. If the current ratio is less than 1, it means that the firm has less current assets compared to current liabilities, and obviously the firm will be having a liquidity problem. Next, we discuss the types of current assets. Remember that not all businesses require similar levels of working capital. For example, a service firm may need different levels of current assets, while a manufacturing firm may require different levels. A seasonal firm may have different levels of current assets than the one whose sales are relatively constant throughout the year. So obviously, the current assets which a firm needs depends on the nature of the business, depends on the nature of the industry the business is operating in, and so much other factors. So there are two types of current assets. The one we call temporary or fluctuating current assets are those current assets which represent the level of inventory, cash, and accounts receivable that fluctuate seasonally. We just discussed that a seasonal firm may have different levels of current assets. So those current assets which fluctuate seasonally according to the season, according to the level of sales the firm is making, these assets are called temporary or fluctuating current assets. On the other hand, we have permanent current assets. Permanent current assets represent the base level of inventory, cash, and accounts receivable, which tends to be maintained. It is irrespective of whether a business is seasonal or non-seasonal, whether the seasonal business has the peak sales season going on or it is its off season, this base level of current assets will be maintained throughout the year. So these current assets which are to be maintained throughout the year, it is actually the base level of current assets, are called the permanent current assets, because the nature of these current assets is relatively permanent as compared to temporary or fluctuating current assets. For example, consider a firm that produces ice cream. So we know that uh, ice cream businesses have more sales in summers compared to winters. So it will have more sales in summers. So in summers, that is the peak sales season of this business. The firm will have more cash, inventory, and accounts receivable compared to winter season. Obviously, if the ice cream business produces and sells ice cream more in summers, so it will have more inventory of the ingredients of the ice cream or the finished good, the ice cream that is ready to sell. It will have more inventory like that in the summer season. And if it is selling more inventory, more ice cream, it will generate more revenue and more cash will come into the business in the summer season. And we know that almost all of the transactions in business world are on credit. So if the ice cream business is selling on credit, uh, it will result in more accounts receivable on the balance sheet of the business in summer season. So a certain level of current assets will fluctuate as per the season. On the other hand, the firm will maintain a base level of cash, inventory, and accounts receivable throughout the year to fund its operations. Obviously, the firm will have to pay salaries to the permanent employees. It will have to pay the utility bills. It will have to pay the rent if it has rented a building or a property or a land or something. So these permanent nature of expenses, for this, the business obviously need a certain base level of current assets to be maintained throughout the year, including cash, obviously, and then inventory, and then accounts receivable. Inventory, because some people also eat ice cream in the winter season. So it's not that the sales will be zero in the winter season. There will obviously be some sales in the winter season also. So for that purpose, a base level of inventory will also be there in the winter season, as well as in the summer season. So these assets, current assets, are called permanent current assets, which are to be maintained throughout the year, irrespective of the season of the business, whether it is the peak sales season or off season. You can see the concept of fluctuating or temporary current assets and the permanent current assets from this diagram. This diagram is actually of a balance sheet of a seasonal business. On the horizontal axis, you can see that there are months of the year, and then on the vertical axis, we have the amount of assets in dollars. In the green color, at the very base, you can see the fixed assets, for example, plant, equipment, machinery, etc. So the fixed assets are not going to change within a year over a period of months. It will not change. And then the permanent current assets are also the same throughout the 12 months of the year, because we just discussed that this is the base level of current assets which are to be maintained throughout the year. The business will try not to go below this level of working capital, because it has to maintain this level of current assets to run its business, to pay its permanent expenses like salaries, utility bills, rent, etc. And at the top, you can see we have the fluctuating or temporary current assets depending upon the months or the sales period, if it is the peak sales period or the off season. It is I can see that this is the depiction of a business which sells more in winter season that we just discussed, for example, the ice cream business, you can see that this business has more current assets, temporary current assets in the winter season, and the firm has almost zero amount of fluctuating or temporary current assets in the summer season. So this is a the depiction of how permanent current assets are or fluctuating current assets work. Then over a period of a bit longer term, means a period of 3 years, we see that the amount of fixed assets is still the same, because fixed assets are not changed so soon, so quickly. And then the permanent current assets are consistently increasing. The level of permanent current assets is consistently increasing because the business will grow. Obviously, the business does not remain at the same level all the time. The business grows. So as the business grow, the permanent current assets, the level of permanent current assets will increase accordingly. And then the fluctuating or temporary current assets will also increase, because if the business grow, it means that the business is making more sales. If the business is making more sales, so the level of its fluctuating or temporary current assets will also increase, but at the same time, it will also fluctuate according to the season within a year or a period of months. Next, we discuss the most important concept, that is the relationship between liquidity and profitability. Remember that working capital is a two-way sword. At one hand, it creates a liquidity problem if kept below what is required to pay current liabilities. And on the other hand, at the same time, it negatively affects profitability if maintained more than required. If we maintain current assets that are not required and we maintain current assets above the required level, we unnecessarily accumulate the working capital in the shape of cash or inventory or accounts receivable, then it will negatively affect our profitability. For example, if a firm needs $1 million cash for paying off its current liabilities or funding its operations, but it keeps $3 million instead of $1 million. So the $2 million extra is the spare cash, which the firm will keep in a current account that usually pays no interest. Because those accounts in which the firm keeps its cash is usually a checkable account that pays no interest. Instead of the firm, if the firm invests the spare cash in marketable securities, that is buying the shares or bonds of other companies, so the firm can earn interest or dividends on them. So keeping spare cash that is not necessary, that is above the required level to pay off the current liabilities and to fund its business operations, that spare cash will obviously affect the profitability of the firm in a negative way. It will reduce the profitability. Here is one example, that if the firm invests that spare cash in marketable securities, it can earn a return over it in the shape of interest or dividends. Similarly, keeping higher levels of inventory will result in increased holding costs. Like if you are selling 1,000 goods per day and you are producing 2,000 goods per day or 1,500 goods per day, that 500 or 1,000 extra goods are not going to be sold in the market because there is no extra demand for your product. The demand is only of 1,000 goods per day. So if you are producing extra inventory, extra goods, extra finished goods, you will have to store that extra inventory somewhere within your own business organization. Or if you don't have space, you don't have warehouses, then you will have to outsource this storing of inventory. And then it will obviously have extra costs, which we refer as holding costs. The same applies to accounts receivable. Accounts receivable does not provide any benefit unless received. Accounts receivable will give you benefit only when you receive it. So Always avoid accumulating accounts receivable and receiving very less cash for your business or against your sales is not something very good. So there is a negative relationship between working capital and profitability, and hence a firm must maintain a trade-off between the two. There should be a balance between profitability and working capital management, and this is the most crucial part in working capital management, that how you balance the two, the working capital and at the same time the profitability, that working capital might not affect your profitability negatively. Now, we talked about the balance between the liquidity and profitability. So the question arises that what should be the optimal level of current assets that we need to have on our balance sheet. So for this purpose, first of all, we discuss cash. Managers try to keep just enough cash on hand to conduct day-to-day business while investing extra amounts in short-term marketable securities. This is exactly what we discussed a few seconds or minutes earlier. That managers try to keep just enough cash on hand to conduct day-to-day business or what is required to pay off the current liabilities. And the managers will always invest extra amount of cash in short-term marketable securities. Inventory, managers seek the level that reduces lost sales due to lack of inventory, while at the same time holding down inventory costs. Inventory should not be so low that you cannot meet your demand in the market. If you cannot meet your demand in the market, there exists a demand for your products in the market, and you are not just producing enough inventory, enough finished goods to satisfy that demand, then you will lose sales. You will even lose those customers. So managers try to produce the level of inventory, the level of finished goods, just to meet that demand in the market. And also at the same time, it holds down the inventory costs by not producing extra inventory beyond the level of demand. Then accounts receivable, firms want to enhance sales. It will also try to maximize its sales, increase its sales, but also holding down bad debts and collection expenses through sound credit policies. This is what I just told you, that selling all the inventory on credit is not always good, because some accounts receivable converts into the bad debts which you never receive, or you take a lot of time and efforts in receiving those bad debts. So it will obviously increase your collection expenses by making phone calls to them, sending emails to them. Most of the time of your employees will be spent on collecting those accounts receivable, those bad debts. So the firm has to have sound credit policies to receive its accounts receivable quickly and easily. Working capital financing approaches. In the starting slides, we discussed the working capital policy, and one part of that working capital policy was to finance the current assets, that how the firm should finance its current assets. So here in this topic, we will discuss different working capital financing approaches. A firm's current assets, that is the working capital, must of course be financed. The question facing financial managers is whether to obtain the financing from short-term borrowing, long-term borrowing, contributions from the owners, that is equity financing, or some mixture of all three. This is the question, main question in this topic that we will address, and then we will discuss the different working capital financing approaches. There are usually three working capital financing approaches. The one is the aggressive approach. The aggressive working capital financing approach involves the use of short-term debt to finance at least the firm's temporary assets, that is the fluctuating current assets, some or all of its permanent current assets, and possibly some of its long-term fixed assets. So in aggressive approach, the focus of the firm is more on short-term borrowing rather than long-term borrowing and equity financing. The aggressive approach is less costly because short-term interest rates are lower than long-term. We know that short-term interest rates are always lower than the long-term rates because short-term borrowing involves less risk for the creditors as compared to the long-term borrowing that we do. But at the same time, it is more risky because the loan must be paid off or refinanced sooner rather than later. It is less costly, but it is more risky for the firm. It is less risky for the creditor, but it is more risky for the business organization, for the firm, for the company, because paying a loan in short term, in a shorter period of time, is always more difficult than paying in the long run, because in the long run, when you have ample time to pay back your loan, you have got enough time to arrange financing, to earn revenues, to earn profit, and then pay your uh, liabilities and loans in the long term. But in the short term, you don't have that extra time. You have little time to arrange funds for paying back your current liabilities or short term loans. The firm has very little net working capital in aggressive approach, obviously, when the focus is more on short-term financing. So there will be less current assets remaining after satisfying all the current liabilities. So the net working capital will be less. Depending on the nature of the firm's business, the small amount of net working capital can be risky. If the firm is of such a type which needs more levels of current assets, a greater amount of current assets, that is working capital, then this low level of net working capital, this less amount of net working capital may be risky because it will create a liquidity problem. There isn't much cushion between the value of liquid assets and the amount of debt due in the short term. So that is what I just said, that it might create a liquidity problem for the firm. This is the balance sheet of a firm adopting the aggressive approach. You can see on the left side that we have three types of assets: the temporary current assets, the permanent current assets, and the long-term assets or the fixed assets. Out of these assets, this portion is the working capital, means the current assets. And on the right-hand side, we can see the financing of the firm from current liabilities, and then the long-term financing from the long-term liabilities and equity. We see that the current assets are up to this level, in which most of the financing comes from the current liabilities, and only this little portion is coming from the long-term liabilities and equity. So when we subtract the current liabilities, this portion, from the current assets, we are left with just this small portion. So there will be less net working capital that we just discussed. The next approach is the conservative approach. The conservative approach involves the use of long-term debt and equity to finance all long-term fixed assets and permanent current assets, in addition to some part of temporary current assets. In conservative approach, the focus of the firm is more on the long-term financing side, because the firm wants to be conservative. The firm does not want to take extra risk. It wants to minimize its risk. So obviously, to minimize the risk, the firm has to go towards the long-term financing rather than the short-term financing. The conservative approach is always less risky than the aggressive approach, obviously, because paying back the long-term debt is relatively easy due to longer available time. But also, the conservative approach is more expensive than the aggressive approach because interest rates on long-term debts are higher than the short-term. Also, the cost of equity is usually greater than the cost of debt. So, on the one hand, if the conservative approach is less risky for the firm, on the other hand, it is more costly for the firm because more focus is on the long term financing, and the rate of return on the long term financing is always more or higher than the rate of return on the short term financing. As a result, more net working capital and therefore no liquidity risk. You can see the conservative approach on the left hand side. Again, we have the amount of working capital, that is the current assets and the fixed assets. And on the right hand side, we have current liabilities and then long term liabilities and equity. So we see that the firm has more focus on the long term financing, that is from the liabilities and equity, to finance its current assets, its working capital. You see that only this less portion, this small portion, is financed through the current liabilities, while this bigger portion, that is half of the temporary current assets and all of the permanent current assets, are financed through long term liabilities and equity. So as a result, the firm will have more net working capital available. So obviously the firm will have no liquidity problem, but at the same time, it will incur extra cost because long-term liabilities and equity will require paying higher rate of return on them. Then the last approach is the moderate approach. This is the in-between approach of the two. In this approach, the maturity of the assets are matched with the maturity of financing. That is, temporary current assets that are only going to be on the balance sheet for a short time are financed with short-term debt, that is current liabilities. And permanent current assets and long-term fixed assets that are going to be on the balance sheet for a long time are financed from long-term debt and equity sources. So in the moderate approach, the firm matches the maturity of assets and the financing, the liabilities and equity. The firm finance the temporary or the fluctuating current assets with current liabilities, and it finances the permanent current assets and the fixed assets with the long-term liabilities and equity financing. As a result, the firm will have moderate risk, obviously, the moderate cost, obviously, and the moderate net working capital. Let's look at the balance sheet. You see that the temporary current assets are financed through current liabilities, and the permanent current assets are financed through or financed with the long-term liabilities and equity. And obviously, the long-term fixed assets are also financed through long-term liabilities and equity. So as a result, the firm will have a moderate amount of net working capital. Working capital financing and financial ratios. Let's look at how this approach, this working capital financing approach, affect the profitability and other ratios of the firm. In all the three approaches, the amount of temporary current assets, permanent current assets, fixed assets, total assets is the same. We are just discussing how the three firms are financing their working capital. So let's look at the financing of each firm or the same firm under different scenarios, different approaches. In the aggressive approach, let's say this is one firm, firm A. It is pursuing the aggressive approach. It has adopted the aggressive approach. So it has financed, it has got financing of $300,000. The amount is in thousands. It has got $300,000 from the current liabilities, $300 from the long-term debt, and $600 from the shareholders' equity or stockholders' equity. So obviously, this is an aggressive approach because the firm is having $200,000 of temporary current assets, but it has got $300,000 of financing from the current liabilities. So the firm is focusing more on financing from the short term, that is the current liabilities. On the other hand, a firm C, which is adopting the conservative approach, has got $100,000 of financing from the current liabilities, and then $500 of financing from the long-term liabilities, that is long-term debt. So now you see that the firm is focusing more on financing from the long-term debt. So that is why this is a conservative approach, means the firm is trying to minimize its risk. The firm is not willing to take extra risk. That's why the liabilities, the financing from the current liabilities is as low as $100,000, and the financing from the long-term liabilities is as higher as $500,000. Then the last, firm M, which has adopted the moderate approach. You see that the temporary current assets are $200,000, and the firm has managed or financed exactly the same amount from the current liabilities. And then $400 permanent current assets have been financed from the long-term debt, $400,000, and the fixed assets have been financed from the stockholders' equity. So the firm has got financing exactly according to the nature of the assets. The short nature of the assets, that are the temporary current assets, have been financed with the current liabilities. The permanent current assets have been financed with the long-term debt, and the fixed assets have been financed with the equity. Now let's look at the profitability ratios and the working capital ratios. You can see that the net income of the firm A, which has adopted the aggressive approach, is $126,000, while the conservative approach, the firm which has adopted the conservative approach, has a net income of $114,000, and this firm M has $120,000 of net income. The highest income is of firm A, which has adopted the aggressive approach. This is because in aggressive approach, the firm incurs less cost as compared to the other approaches, because short-term financing is always less costly compared to the long-term financing. So if the rate of return or the rate of interest on the short-term financing is lower, then obviously there will be less fixed financing cost, interest expense that we deduct from the operating profit, EBIT, and as a result, we will have more net income left with us after paying the interest expense. Similarly, look at the net working capital. It is also the minimum compared to the other two approaches, because more focus is on short-term financing. So there will be less amount of net working capital. And the current ratio is also lower compared to the other two approaches. And then look at the debt to total assets ratio. Debt to total assets ratio is similar because financing from the debt is equal in all the three cases, all the three firms. 300 plus 300, 600 debt financing, 100 plus 500, 600 debt financing, and over here also $600 financing from the debt. But the difference is in return on equity, because over here the firm has got more net income. So the return on equity of firm A is 21%. The return on equity of this firm C, which has adopted the conservative approach, is 19%, and firm M has 20% of return on equity. So this was all about the working capital financing approaches. Now let's look at the summary of the cost and risk factors of all the three approaches. In the aggressive approach, the cost is low and the risk is high. In the conservative approach, the cost is high and the risk is low. And in the moderate approach, the cost and risk both are in between. So with this, we come to the end of this chapter, and we will be back with a new chapter in the next video. Till then, take care.